Welcome to the Personal Pension Radio Podcast, where it's all about helping you complete your financial journey to retirement. Discover time-tested strategies and get unconventional insights into wealth building and retirement that actually work. Break away from the herd and go for the retirement you dream of. And now, here's your host, the income engineer, Kraig Strom.
All right, here we go. Personal Pension Radio. Thank you so much for downloading, listening, wherever you are, in the car, on the treadmill, walking the dog, wherever you happen to be. This is Personal Pension Radio. I am the income engineer. If you ever need to get in touch with me, it is Kraig with a K at kraigstrom.com, or you can catch me on LinkedIn, Kraig Strom on LinkedIn. You can Google me. Either way, I will come up on the first page of Google as long as you spell my name correctly. My mission is absolutely that retirement dream that we've all heard about. It's driven by maximum lifestyle income, right? The retirement dream isn't, I'll just get by. The retirement dream that has been sold and pitched for years and years and years is, on the beach, you've got your Mai Tai or your little fancy umbrella drink or wherever your, quote, beach is in retirement. That's the mainstream dream, right? To get to retirement. That is my mission, is to help you get there. But in order to do that, you've got to pull back the curtain on the Wall Street advice that's out there, that mainstream financial advice, to make sure that you actually know that most advisors, they were educated by that same machine that taught me the messaging that worked best for Wall Street. That's it. I've said this several times last week, where I asked this question to folks who asked me, hey, why haven't I ever heard that before? Because I would share something like I did on the last episode, like the 4% rule, right? And they would ask, well, why haven't I ever heard that? Well, I answer that by asking this question, and I've asked it many times, and the answer is always the same, but I'll ask you right now. Think about this. Does Wall Street have any financial incentive to teach me, a financial planner, how to teach you to take money out of their system? Well, of course not. Wall Street has no financial incentive to teach me how to teach you to take money out of their system in maximum quantities. That is not beneficial for the Wall Street system. So, of course, they don't teach that. Now, that means that the advice on retirement is incomplete. It truly is. The answer to every question is always invest more money, diversify, dollar cost averaging, et cetera, et cetera, et cetera. And the reality is the answer to maximum retirement income is so much more than that. The answer to maximum retirement income means that a singular product, a 401k, life insurance, real estate, stocks, and other investments, those things by themselves, they do not fix the maximum retirement income question. You've got to have an actual strategy, a comprehensive approach. And that's what I do. Now, full disclosure before I jump in, I am not an attorney. I am not a certified public accountant. I am a CFP, certified financial planning professional. All that said, and as qualified as I might be, please don't act on things that you hear on this show as if you're getting advice for you personally. You've got to meet with a qualified financial planner. Of course, I hope that person would be me. And you can schedule an appointment with me by just sending an email to Kraig with a K at kraigstrom.com, Kraig with a K, KraigStrom.com. And I'll send you back a link. We can just book an appointment. I work with folks all over the country. Through the miracle of technology, I can actually connect just remote. You can be in multiple locations. I mean, as a husband and wife, I've actually met with folks who are at the office with a spouse that's out of the country at the time, right? So he was in London. She was in Southern California. It works, folks. Please remember, though, don't act on things that you hear on shows, especially from financial entertainers. unlicensed, unregulated, unmonitored folks who are just giving out random bits of advice as if it was financial planning advice. Now, let's jump in. No deal of the week this week. I've actually been working on the same projects and didn't have anything jumping in. If you've got a deal of the week, I want to put this out to you. I'm always curious to hear what someone else has found out there as a deal of the week. So please send me an email, Kraig@kraigstrom.com, deal of the week in your subject line. And if I think it's absolutely cool, I will definitely share it with the audience here on the show. I would love to do that. This week was actually pretty low-key, working on the same things that I've already been working on. So I'm going to jump right into Watch Your Step. Watch your step. Last week, I did actually cover the 4% rule. If you want a good primer on the 4% rule and what it means, go back and listen to the last episode for sure. Trust me, the 4% rule is not something that you want to retire on. Unfortunately, it is exactly what Wall Street has been telling people for 35 some odd years, and they keep telling them 4%. So please, you definitely don't want to invest on the 4% rule or retire on the 4% rule. You've got to know what it is before you can avoid it. This week, a question that comes up often: to invest or not to invest? So watch your step on this, okay? Watch your step. This word, or this phrase, irrational exuberance, it's a real word, real phrase used to describe situations exactly like the one we're in right now. What has the stock market done over the last 8 years? It is just this parabolic upswing. It's awesome. This is great. Everybody's excited. Well, what happens when that frenzy of buying and the rising up of the markets, it just gets exciting and people get irrationally exuberant, and they ask me questions like this. It came in last week. It's like, hey, man, my daughter is 2 years from going to college. I'm wondering if I should increase her college savings account monthly savings that I do. I should bump that up to $1,000 a month, right? Well, what makes you say that, I ask? Well, she's 2 years away, and man, the market's just cranking along. It's great. I'm like, whoa. Had to slow this person down. Let's think it through. Number one, this is a college planning question as far as saving for college, right? We're only 2 years away. What is the most important aspect of the compounding growth equation? If you're going to look at compounding interest or compounding returns, the most important part of the equation, I would suggest, is time. So how much time does this guy have? 2 years. Well, there's no time. There is no time for the effect of compounding to happen, right? And where are we in the market cycle? Well, we're at the top. It is argued, well, maybe we're not exactly at the top, but the roller coaster is clicking right on its way to the top, right? So is now the time to jam a bunch of extra money into an account you're going to need in 2 years? No, it is not. If it's something maybe 5 years or more that you could afford to take a market correction, no. When could that market correction come? Is it possible that market correction could come within a year, within 24 months? And that would be exactly the wrong time that you'd want to experience a market correction in a college planning account that you need to pay for college, right? We're at the top of these markets right now. And I say these markets because so many of the markets are just up, right? We're at the top of the real estate market. We're at the top of the stock market. Putting in extra cash for this individual was more appropriate to even just bank it. Just put it in the bank because you're going to want to keep that money safe and ready to deploy for school, right? Because if he puts that into his college savings account right now and fully invested, it's entirely possible that there would be a market correction in the next 24 months that could wipe out a big chunk of that. So why risk it right now? We don't have the time value on our side in this question. So please, watch your step. If you find everybody around you talking about, ooh, this or ooh, that, and wow, I got to invest in that. Whoa, slow down for a second and remember this irrational exuberance conversation here on Personal Pension Radio. Now, another big watch your step. This is a twofer on watch your step this week because this just makes me mad. I want you to heads up, think about this. If you're a CPA, if you're an attorney listening to this, if you're a professional advisor listening to this, know that I'm talking to you and thinking about you as I'm going through this because it really does just burns me as I'm thinking about this. Recently, I was introduced by a client of mine to a widower, a husband who lost his wife to cancer last year. It was cancer they knew was there, but then it just really just jumped up and took her quickly. It was just very unfortunate. And she's young. She's in her 60s. It just wasn't, it's just an unfortunate situation. They live together still on joint income and on a business that she ran the business. He was really a silent partner, but she was the business, okay? She was part of a class action lawsuit, and the settlement is going to be very large. It's going to be a very large amount of money. Now, lawyers for the settlement case will not send the husband the money for the settlement because the estate may need to go through probate. What? Hear what I just said. There's a huge settlement out there. They lived on joint income, basically coming from a business that she ran, and now she's gone. The income from that business is at risk. The widower, the husband, survivor, is barely hanging on, doesn't have a whole lot of cash left, and was expecting to receive this class action lawsuit settlement that he would ultimately be able to survive financially. Well, now the lawyers for the settlement case, who had been working with this couple on this settlement for months and months and months and months, never mentioned any of that. Never mentioned that, oh, by the way, if she passes away and you do not have your estate in order, well, we won't be able to send it to you until you settle probate. What in the world is going on? This means that a group of attorneys out there did not ask the right questions. They didn't help this couple get prepared for what they knew was going to happen. She was going to die. There was no ifs, ands, or buts about it. Okay? Now, this couple had gone to LegalZoom. Sadly, they just wanted to save a few bucks. So they went to LegalZoom and they got wills and trusts and that kind of stuff. And the trouble is that she got sicker much faster and they never finished the documents. We thought we had found some finished documents, but not valid. That's what happened. They weren't valid. They weren't signed. Even some of the basic documents were just missing one or two additional signatures that might have helped. But no, they were not signed. So this means that the assets of the wife, who's now passed away, will have to go through probate in California. Folks, what that means is they might have saved $1,500 by going to LegalZoom, but it could actually cost the husband his house and $30,000 in probate fees and lawyer fees and everything else. Hear that. Saving $1,500 because I don't want to pay an attorney to do my will and my trust and everything. I don't want to talk to a financial planner who could help me. I'm going to save $1,500. No, there's an entirely good chance that it's going to cost your family, your survivors, your loved ones, a huge amount of money. And the terrible part is that probate in California is 18 months minimum. 18 months minimum. The survivor, the widower, will be broke and living on a basic Social Security check by the time probate finally settles. I'm telling you, folks, this is scary. There may be some options. We're working on it now. We've got lawyers involved. See, I've already made introductions to the widower, to the husband, to speak with some lawyers to see if there's any way that we can sort this out. Folks, you get what you pay for. LegalZoom is worthless if you don't execute it correctly. And that's where the big risk comes from. Get good counsel. Talk to a financial planner first, someone who can help to coordinate everything, okay? Now, questions in segment 2. This question came in last week, was regarding special needs planning. And my big advice was get life insurance. If you have a special needs child or family member that would be financially in bad shape if you were to die, goodness me, get life insurance and put it in a special needs provision in a living trust that an attorney helps you with, okay? Please go back and listen to that episode. If you know someone with a special needs family member, please go back and listen to the last episode. Share it with them. Now, this week, this question came in from a podcast listener that said, am I diversified? They sent me a copy of their investment account statement. Now, congratulations. They have got a great amount in their investment accounts. It's excellent. Really good. And I asked them if they felt that they were diversified, and they said yes, because their investment professional has them in these 7 different investments. Okay, so let me just tell you straight up. They sent me these 7 investments, and I already knew they weren't diversified, but I always like to research it and give more than just my opinion. I like to actually give real answers, so I like to research it and dig in. I'm a geek for that, okay? So they have 7 different investments. These are pooled buckets of various investments in their account, okay? In 3 different accounts, I mean. Now, here's the thing. 7 of them, and here's what I do, is I go to a chart. It's very fancy. It's really exclusive. It's so difficult to get to. I like to use Yahoo Finance. Yahoo Finance is available to everyone, and you can do this yourself. So what I do is I go and I pull up a chart of the Standard & Poor's 500 stock market index. And then I overlay each of the 7 investments on a 5-year plan, a 5-year period, and I overlay those 7 investments and compare them to the S&P 500, which is the Standard & Poor's, the biggest companies in the world. Okay, now, guess what? All 7 of the investments that they are supposedly diversified move up and down at the same time. When the stock market S&P 500 moves up and down, they all move up and down in the same places, some more severely than others. But the point is, folks, if you are all 7 of them are lockstep moving up and down in the same directions, are you diversified? No. That is a clear indication that you are not diversified. Diversified investments will tend to move in different directions. One goes up, one goes down, one stays flat, one goes up. They move in different directions, okay? So number 1, these folks were not diversified. And as part of my questioning, I was like, well, why do you work with an investment advisor? Oh, I want to have, professional advice, et cetera, et cetera, et cetera. I said, well, that costs money, right? Oh, no. They don't charge any kind of a fee, they say. No. There's no fee. It's just whatever the investments themselves cost. That's what our cost is. Well, of course, the investment advisor gets paid. they get paid. These folks were kind of oblivious to that. They're like, oh, yeah, okay. They don't really know what it really costs. Okay. So let's take a look at it. Number one, they are not diversified. When your investments, you go to Yahoo Finance and map it out. When they all go up and down together, you're not diversified. You're lockstep. You're completely correlated. It's correlated. Okay. Now, the other piece is fees. That's what I was going to get to. So in their case, these folks, they think they're getting the advice to go, with a financial advisor, but they don't have to pay for it. Their fee is 0.65% on average. That's not bad. That's not a bad thing at all. But let's take a deeper dive, though, at what that really means. That if over the course of 25 years, these folks are young. So I said 25 years. Let's just take $12,000 a year saved into this account. And if they could earn 8%, $12,000 a year at 8% is $947,000. That's awesome. But you don't get to invest for free. So $12,000 a year for 25 years at 7.35%, of course, that's 8% minus those investment fees. Instead of $947,000, you end up with $856,000. That's a $90,000 difference. Over the course of 25 years, 0.65%, which sounds so cute and cuddly and small, that's a $90,000 block of fees, basically that money eroded out of the investments, okay? So a 0.65% fee erodes $90,558 out of this example, okay? So now, going back, though, we've got to dive in a little deeper, right? So we've got 7 different investments. We're clearly not diversified. However, there's additional piece because these are pooled buckets of investments. There's something called turnover. And in this case, the average turnover in their investments is 38%. What this means is that there's a big bucket of investments going on, and every year, on average, the investment management teams are buying and selling and turning over 38% of the portfolio. Now, that's not huge. There are some much larger percentages of turnover, but what that means is they end up with capital gains and losses. They end up with taxable income in many cases on assets that they didn't necessarily want to sell, but because the investment management team turns over the portfolio, 38% of it, it generates capital gains, which means taxes on money that they've never seen, on profits they never saw, because it's inside their pooled investment. So turnover is a big deal. These folks actually have a large enough account between their 3 different accounts that they could have a very nice diversified portfolio on their own without pooled investments, and it would eliminate a good deal of capital gains taxes that they have been paid. That's a whole separate story, folks, but that's a key piece there, okay? Now, they were really about just do it yourself, but they thought they really should work with somebody, and the key is if they really wanted to do it themselves and get the basic same results, remember, what did we say? They're tracking the Standard & Poor's 500. Well, they could track the Standard & Poor's 500 on their own. They could, cheaper. They would not be truly diversified away from just the markets, but they would be saving a lot of money. So in my example earlier, remember, their current portfolio, in my example, would cost them over $90,000 in lost growth because of the fees. And again, that's not gigantic in the world of investments, but it's a significant amount of money. If they invested on their own, in their own account managed by themselves and just held on to it, the cost savings could be as high as $76,000. They could actually have the same performance for $75,000, almost $76,000 less. Folks, fees are a critical piece, but diversification is also one of those big things out there that most people misunderstand. Just because you have 7 different pooled buckets of investments in your account doesn't mean you are officially diversified. In most cases, it means you are not, okay? If you want to know whether you're diversified, and if you want to know what your retirement income analysis really looks like, email me, Kraig at kraigstrom.com, subject line, am I diversified? Retirement income planning, whichever one you're interested in, write both in there if you're really interested in it. If you want to know if you're diversified and you want to get my take on it, absolutely. Get in touch, Kraig at kraigstrom.com. And I'm going to go back to watch your step. If you have not done your living trust, your wills, your powers of attorney, if you've gone to LegalZoom, and you don't know for sure that you've signed them or executed everything correctly, if you want to just have a quick conversation and a double check on this stuff, please, Kraig at kraigstrom.com. I'm here to help. I just can't stand these kind of situations like that where CPAs and financial advisors and lawyers even out there with their clients, and they haven't prepped them and alerted them to taking care of this. I want to help you make sure that your family never has to go through that probate nightmare that this poor husband is going to be going through. And I just know it can be fixed for you if you just take action. That's the key. Take action. Hear this stuff and then just pull the car over, get off the treadmill, put the bike down, and send an email to Kraig at kraigstrom.com. Let's talk. I will get back to you again with another episode next week. Take care.
Thank you for listening to the Personal Pension Radio Podcast. If you missed anything during the show, that's okay. We took the notes for you. Check the show notes for links, offers, and a full transcript. And don't forget to head over to personalpensionradio.com and download your free retirement income report. While you are there, we would appreciate some iTunes love. Please leave us a fantastic rating on iTunes by going to personalpensionradio.com/iTunes. Thanks again for listening.
Now for the disclosure. Information presented is for educational purposes only and is not intended for solicitation, sale or purchase of any security or financial product. Be sure to first consult with a qualified financial advisor and your tax professional before implementing any strategy discussed here. The term personal pension refers to a marketing name designed to educate future retirees and retirees about the economic principles behind creating their own pension-like income. The term personal pension is not intended to be confused with a defined benefit pension plan offered by an employer or by a government entity.